Good evening, everyone. Welcome to another webinar of Viking Capital. Today is going to be a fun discussion. My co-host, Chris Paranello, and I are going to discuss the Federal Reserve, the interest rates, the current economy, multifamily real estate, and how we can navigate this to be highly successful as investors. So again, congratulations on being on this webinar and welcome. All right, let's just do a quick sound check here. How's everyone doing? If you guys can hear me, go ahead and put in your chat box where in the country you're calling in from or you're watching from. I'd love to see the representation we have here. And Chris, welcome. Good to see you, my friend.
Yeah, thanks, Vic. Thanks for having me.
Absolutely. So guys, we got people from all over the country here. We got Tennessee, San Antonio, we got Chicago, Ohio, Houston. Awesome, guys. I was just in Austin with Chris getting more details on one of our assets, as well as meeting with a lot of investors. And so I really like that state. I really like the Austin, San Antonio corridor. There's so much growth going on there. It was interesting, like the Mag 7, all the stocks that everyone watches in the S&P 500, the ones that lead the S&P 500, they all have major operations in Austin, Chris.
Yeah, no, and I think San Antonio is growing as well, and that corridor right in between is the next metroplex that you're going to see that it emulates Dallas-Fort Worth. It's really cool to see how much it grows. I was in Austin in 2013 when my sister was going to college at UT, and it drastically different. You're talking major growth in the last 10, 11 years.
And as we're about to start this webinar, I wanted to share some powerful information I did research on. I've been reading the Wall Street Journal, the Financial Times, a lot of our industry newsletters that come out from the top brokerage companies, some of the data from things like Blackstone and Goldman. And it's interesting, Chris. We thought we were heading toward a recession. Wouldn't you agree?
Yeah, I think that everyone agreed 6 months ago.
And there's sort of 8 reasons why, or probably 7 main reasons why this did not happen. And so we know the Federal Reserve raised interest rates between March 2022 and July 2023. And it was not just a minor amount, right? They really ratcheted it up. And we can talk about all of that during our presentation in a second, but it was expected to cause a credit crunch and a recession. And this normally has happened in previous situations, right? And we were starting to see some of the hints of a recession. We were using what we call leading indicators. And so there's something called the yield curve, right? And it became inverted. There was declining leading economic indicators. There was negative growth in the money supply, right? And so all of this said, okay, we're heading toward this recession, but it ended up being misleading. And normally, historically, these recessions, they've been triggered by a few things, right? There's credit crunch, right? There is speculative bubbles that burst. There's spiking oil prices. Now, to be fair, we did see that. There was a brief banking crisis, which we'll talk about, me and you, when we get into the presentation. And there were some oil price spikes, especially with the wars going on. But it didn't really lead to a prolonged credit crunch or recession. I think, first of all, the U.S. economy is damn resilient, which is super impressed by. The consumer spending remains strong because, look, people were smart. During those crazy low interest rates, there's a tremendous amount of people who refinanced. And so there's trillions of dollars of equity locked into people's homes. And the other thing is baby boomers, they like to travel, healthcare, dining out. And even though there's tight monetary policy, the interesting thing was there was a stimulative federal policy. The federal government actually went bonkers and they did infrastructure spending and they did all the spending. So that offset some of that tightness. Corporates did very well. Corporate profit remained strong and robust. And then finally, I think the main thing that seemed to make us miscalculate the crystal ball, as economists were, they really focused on the goods sector, which did come down, but the services sector remained super robust. And that is what sort of helped us be resilient during this time. So this is just my little take. I thought it was a very interesting way to think about the economic cycle and how sometimes economists, historically, they could have been accurate, but in these unprecedented times, maybe it's time to look at new economic indicators. So with that said, Ashley, let's get the ball started here. I think everyone is joining in here. Okay, a brief little history, guys. If you don't know who we are and our company is Viking Capital. We were founded in 2015. My partner, Ravi, and I were physicians. That was our background. And we had a passion for real estate. We had a passion to help high-income professionals grow their wealth. We wanted to grow our wealth. And we created this company to invest in real estate initially, and then we wanted to take it to the next level. So we really eventually evolved into a private equity company that is purchasing institutional assets across the country and really providing these 5 main key advantages to our investors. Number 1, cash flow. Number 2, the tax advantages. 3 is growing meaningful equity, diversification across portfolio and across asset types. And then finally, having that appreciation work for us. And as I mentioned briefly, my background, again, I was a founder. I was a founder of Viking Capital. I was one of the key partners in a private practice. I've grown multiple companies. I'm a serial entrepreneur. And right now, Viking is sitting right at close to probably $875 million. This is a little bit outdated slide, $875 million. And we'll probably hit the $1 billion mark this year. We've deployed about $350 million in private equity, and we've been honored by a lot of these organizations. Next slide. And my director, Christopher Paranello, he is been in the private equity space for years. He's worked at other institutions before. And now since his joining of Viking Capital, he's really taken us to that next level of investor education. And he sort of jokes that we're an education company that happens to do real estate instead of a real estate company that happens to do education. So Chris, welcome to the program, and you can say a few words to our audience.
Yeah, absolutely. Many of you have had a chance to chat with me, do a performer review, kind of go through some of the deals that we've had in the past. But my role with the company is really to lead our investor relations team and partner with our marketing team to make sure that the things that people want to learn about, that we're giving insight into, and then I'll also giving you a short-term option to steward some of your capital into deals that we acquire.
So a quick glance at our portfolio and performance. So one of the biggest things, especially during this unprecedented volatility, is that track record does matter. We were proud to say we never lost a single investor dollar. And that's meaningful because as we started initially, it was just friends and family. And so it was important for us to make sure we treated everyone like family. And then now as we've grown to becoming more of an institution, that same credo still holds true. And we've never made any capital calls. And our number one focus is obviously capital preservation. We've done 26, soon to be 20, I guess 27, perhaps 28 properties. We've talked about our assets. We've talked about what we're getting close to 5,500 units under management, and our average exit LP investment KPI is 24% average annual return. We are growing our team to have that high touch, white glove service that you all know, like, and respect, but also have that institutional level expertise that's needed to navigate and play with the big boys. In fact, Chris will tell you about what's going on with some of the Blackstones of the world, the KKRs, the Brookfields. He has some really interesting statistics to share with you. But having someone like Judah, who has probably almost a decade of experience in multifamily, Ed, who has almost 25 to 30 years developing properties all across the country. Actually, this has been one of our ninjas in marketing, and really having a robust secondary team to help service all our investor base is very critical to our growth. So what we're going to focus on, guys, is the current Fed fund actions and how it impacts your investments, what investment dynamics you should be looking for, how multifamily is affected by the Fed fund rate, and we're going to give you a bold prediction of what Viking thinks the Fed's next move will be. And I'll probably end with a 24-month game plan of how we're going to show you how to take advantage of these very interesting opportunities that are available. Chris, off to you.
Yeah, absolutely. So apartment demand, here we're going to talk about what's really driving the market. I think a really great way to start this is just kind of talk about what happened coming out of the GFC and how we really pushed all the way through COVID and where we are today. You really are starting to see home prices, home values, and all of these types of values kind of skyrocketing to where normal folks aren't able to buy homes. And a lot of folks that are new to the market, young renters, really are being priced out of the market. So you're noticing that rental demand is at an all-time high. Next slide. So apartment market fundamentals. I think these are really important. And I think what really is important to focus on is multifamily as a whole. There's a shortage of supply. And when you look at some of these data points, you can see that rents in some major markets are flattening to a certain extent, but in some really tertiary and secondary markets, you're still seeing a lot of growth. Ultimately, interest rates are causing prices to really get devalued. And the next slide. So who is driving the market? As we've been discussing, millennials, people are trying to not...
So the key really is millennials are the ones that are driving this market, right? They're in the prime rental range. You can see it here, right? From the ages of 28 to 42, that is a huge demographic of people. And there's 72 million of those millennials. And the time that they're doing the marriage and the first home purchase, that's their goal. They can't afford that right now. And you can see here from age 20 to 34, they're living in, there's a majority living in rentals. And even people 35 to 44, you'd think they'd be buying homes. Almost 40% of those guys are living in rentals. Next slide, please. So, Chris, you want to tackle this one?
Yeah, so migration patterns. You have folks moving to certain areas of the country. You'll notice the purple areas on the slide, California's, New York's. These are the expensive markets. Texas, Florida, Tennessee, where rents are a lot cheaper. You have a lot more jobs, a lot more performance, are capturing a lot of the inbound migration. So where have we been? So what has the Fed been up to, and what's their thought process behind it? The Fed raised the federal funds rate much quicker than they have in history, 5.5 basis points in a matter of 8 months. And what that has done to valuations and properties has been detrimental. However, this creates a really great opportunity for us to find a lot of opportunity in the market. So this can show you how significantly rates rose from 2022 to 2024. 500 basis points is going to cause prices and valuations to shrink dramatically. Jerome Powell, a lot of people are trying to figure out what exactly is the Fed going to do and what are they looking at. So the Federal Reserve inherently is looking at a bunch of data sets. And the reason they're looking at these data sets is they have an obligation to tame inflation and create as close as they can as a soft landing. So what has the Fed said over the last 6 to 8 months? They started with, we're going to have rate cuts in March, then maybe June. Now they're talking about rate cuts, maybe 3 throughout the rest of this year. I think if I was being asked to decide what I thought was going to happen, I would say 2 is likely, or maybe 1. And really what they need to see is that inflation is actually coming down. So one really interesting tidbit that I've found in the last few weeks is that the European Central Bank is actually ahead of the United States in one certain aspect. And really what they're seeing over there is the economy is slowing and they are seeing inflation get under control, but their unemployment rate is double our unemployment rate. And one thing that's coming out is that their leader and their central bank is going to cut rates before the US does. Now, what Jerome Powell and our Fed has to really take into consideration is that when they tighten monetary policy and they raise interest rates, what they're looking to have happen is something to break. They're looking for unemployment to go up. They're looking for consumer spending to curtail. But the opposite is what we've seen. And I think one of the reasons is we're facing a lot of tailwinds. So what is a tailwind? A tailwind takes you, and even though interest rates are high, consumer spending is still growing. Unemployment is still low. And why is that happening? And it's mainly because, if you think about it, Vic mentioned this a little bit earlier, you have a whole group of people that were able to refinance into really low cost debt. You got a mortgage for 2.6%, but you refinanced your cars, you did a lot of those things. So a lot of folks right now aren't feeling the pressure of high interest rates because they're already refinanced into lower debt. Now, an interesting thing that I picked up on is it isn't just the consumer that did this. You have really large companies that in 2019, 2020, 2021 took a generational interest rate market that was extremely low and they cleaned up their balance sheets. So outside of folks that are using a short-term debt for long-term investments, most companies have really clean balance sheets. And the reason that's important is because it increases a really large lag. And when you have this really large lag, you notice that the Fed, even at 5.5 basis points, because they're not seeing the negative impacts in the economy, there really is no reason to lower interest rates. And if you ask me, and from the seat that I'm in at Viking Capital, I would prefer that the Fed leave interest rates higher for a little bit longer because it creates a lot of opportunity. And we're seeing that right now on the ground level.
Yeah, and if you could just go one slide back, I would like to stack on what Chris is saying. So a lot of the research I've been reading is there may be a decoupling. Normally, the United States and the European Union usually walk in step. And because of our drastically different economies, there may be a decoupling where we may see a situation where the European Central Bank may lower interest rates, but the Fed may still feel that the time is not right. And that may be okay because, again, the economies are sort of operating in different ways. We're much more resilient than the Europeans at this point. Next slide.
Yeah, so what is the right time? And I think this is one of the most important slides that we're going to be showing, and it's really showing seller's market versus buyer's market. when the Fed increases interest rates, there's a cause and effect that happens, and it's all based on supply and demand economics. So with high interest rates, you have lower transaction volume that's currently happening. You're seeing this in multifamily. You're seeing this across the entire spectrum of products and services. And what that creates is a buyer's market. You're able to get a discount to goods, and people are realizing that if they want to transact in this market, they're going to have to lower their prices. Now, if you go back to 2021, 2022, and the beginning of 2023, you were following this curve in the seller's market where cap rates had compressed so low that if you had bought a property and you had increased NOI and with the cap rate compression, you were able to sell, and a lot of people were getting 2x returns in 24 months, 35 months, Viking no different. So it's really important to track these things because that seller's market was pretty short-winded. Once we got through that seller's market, the buyer's market begins. And as we navigate through that buyer's market, we have to try to forecast what's going to happen in the future, and what dictates that is going to be monetary policy and what the institutions that control a lot of the capital decide to do and when they decide to be more active. So not if, but when. So the Fed has kind of telegraphed. They come out and they gave FOMC minutes today, which are really just a minutes report on the last meeting. But what was the prevailing thought process on all of these minutes? It was the economy's not breaking. The stock market seems to be doing well. Inflation is lower, but it's not low enough. So they're letting us know the likelihood of a Fed rate cut in June isn't very good. 2-3 months ago, they thought definitely June, maybe July, we're going to see some kind of relief. However, it doesn't make sense for them to lower those rates. So in my opinion, it isn't necessarily if they lower rates, it's when, but more importantly, what you have to ask yourself is, what do I do if they don't lower rates? And what do I do when they do lower rates? How am I going to participate in this market and really create an opportunity for myself? So the stronger growth has led to higher for longer bond yields. I think one important thing to discuss is the federal funds rate hasn't changed. It's paused for several meetings. However, when you look at the 10-year treasury, which is really important to multifamily groups because we correlate our rates and exits to the 10-year treasury. When we go out to get a loan, it's correlating to the 10-year treasury. Even though we've been at 5.5 for 4 or 5 months, you've seen the 10-year treasury bounce around all the way from 3.8 up to, it was at 4.8 2 or 3 weeks ago. And now today, the last that I looked at it a few hours ago, is at 4.42. And the reason that this is important is because the Fed has a few tools. It can raise the fund rate and it can lower the fund rate and it can buy bonds. But outside of that, the 10-year treasury and a lot of these bond things are still run similarly to the stock market. It's based off of people buying and selling bonds. And that phenomenon is going to create this economic surprise index where even though the Fed rate hasn't changed, it's gone down. The reason that that's important is because when the Fed does decide to lower rates, it isn't going to be an immediate buying spree. You're going to have some time to react. And what that's going to cause is an indication that costs are lower and people can participate in the market. So SOFR curve. So, and this kind of shows a Fed dot plot laid over 1 month, 3 month SOFR curves and the 10-year treasury. So the reason that this is important is because if you look at where we are today in June or so of 2024, you can kind of see where the 10-year treasury is. That's what's going to correlate to agency loans and things today in the market. Now, if you're looking at short-term rates or variable rate loans, you're going to follow a spread over SOFR. And those you can see, all of them are kind of dipping in synchrony as you go out because the prevailing thought process is that maybe we're not going to cut rates too much in 2024. 2025, you might see a couple. At a certain point, you're going to have a reaction from the market that's actually going to show that the economy is not doing as well as we thought we were, and you will see the cuts come. So this is another really important slide because it shows what different asset classes in commercial real estate are doing from a cap rate perspective. And it kind of forecasts this out as well. You can see over time how they've reacted. You can see how they reacted in 2008, where cap rates all went dramatically low. And then right after the recovery of the GFC, you could see that they expanded. So they'll usually come to a peak and then they're going to start coming back down. And the reason the cap rates compress and expand like this all has to do with economic fundamentals that are very rudimentary. So it's supply and demand. And as cap rates come down and they start compressing, it encourages people to be more active and transact more in the market. So this is a really great slide. And I think this is one of the great indicators of what you think the Fed's going to do. So a Fed dot plot, really what this is the FOMC and the Fed core advisory comes together. There's a certain amount of members on that meeting, and each one of these dots represents one of those members making a vote. So when you see the median number down here, you're looking at what the groupthink is at the FOMC on when things are going to happen. So in 2023, it was very clearly everyone in the FOMC thought rates were going to be elevated. 2024, it was a little bit more mixed. Some people truly believed that we were going to see rate cuts, and we still may see 2 to 3 rate cuts this year. A lot of people thought that we might even go higher. Now, when you get into 2025, and keep in mind, this is a forecast today of what's going to happen in the future. You get into 2025, there's a little bit more uncertainty. You have people thinking that we're going to stay relatively high. You have some people that really believe that cuts are going to come in abundance. Now, as you get longer out, 2026 and larger, you can see the concentration is all showing the prevailing thought and what the majority of people that are in charge of this federal funds rate, where things are going. By the time we get to 2026 and 2027 and 2028, everyone's anticipating the federal funds rate to be sub 3%. And that's really important because when you're investing in a multifamily opportunity or any commercial real estate that follows a 5 to 7 year hold, what you're really trying to do is buy in the best time of the market where you might be getting a discount at an expanded cap rate, and then being able to time the market to where you can exit at a compressed cap rate. And the Fed, through this dot plot, is really painting the picture of what it's going to look like if you invest in a property today in 2024. When we go to sell it in 2029 to 2031, it's going to be in a good position to exit and maybe even exit early. So I think that one of the big things, and Vic alluded to this, the big thesis here is you believe interest rates are high. Interest rates being high are causing transaction volume to slow. So people that are still able to act nimble and buy deals in this market are buying them at a considerable discount. We're seeing 15 to 20%, even higher in some cases, to what they were a couple of years ago. Now, when cap rates compress, what's going to help make them compress is going to be the federal fund rate going down, but also institutional capital coming back to the table. People say, well, when will the institutions come back to the table? How long are you going to have of this opportunity where you're not competing with the institutions? Well, I think that it's already happened. You can see in the last 45 days, Brookfield, KKR, and Blackstone have all made major purchases. Brookfield just a few weeks ago bought 7,300 units in Florida and Texas, and they bought them at an average of $212,000 a door. KKR bought a 19 property portfolio for $1.65 billion, and Blackstone spent $10 billion on buying the apartment income. So in the last 45 days, you've seen roughly $15 billion of institutional capital buy over 100 properties in multifamily. And that is a huge signal and not one to be overlooked.
And let me stay on this slide for a second, actually. So, Chris, what you're saying riveting, because what you're telling me is the smart money and perhaps the early money is now starting to get back in because they sense a bottom. Is that sort of...
It's a couple things, right? So it's, yes, they sense a bottom, but two, if you were an institution and you had $1 billion of capital that you have to place, where would you put it? Where would you put it today? And where would you put it to preserve capital? You're probably not going to put it in hospitality, probably not going to put it in retail, definitely not going to put it in office. A lot of people feel like what the Fed has done is kind of like steering a ship. So if you're steering a ship and they do cause a recession, then there's going to be some stock market volatility. So you're probably going to get out of some traditional equities. And one of the safest things that protect you and mitigate risk in many different ways is multifamily. And that's kind of why it's become the belle of the ball, because here it is, a hedge against inflation and a primal need of shelter. Folks can't afford to buy homes because interest rates are too high. And what's given the institutions the ability to sit on the sidelines with all their dry powder is the debt market. So if you're holding $1 billion in cash, waiting for the right opportunity, and you're collecting 5.5% on that cash, you bought yourself some more time. And eventually the Fed's going to lower rates, and that's going to force those institutions that are holding that dry powder on the sidelines to put their money somewhere, because they're not going to be able to get 5.5% anymore in a bond.
Yeah. And I want to just pull up these about 7 or 8 points of why we are sort of bullish on multifamily, and Chris alluded to many of them. First of all, there's demand for multifamily units. It surged to about 103,000 in quarter one of absorption, meaning new multifamily came online and it was quickly rented out and leased up. This is the highest first quarter total since the year 2000. The second thing is the economic viability of renting. It is essentially unaffordable to do a home ownership, because the rental cost and home ownership costs are almost $900 difference. And so there's also a 14-year low in mortgage applications. In terms of operating performance, there's resilience here. Despite a rise in vacancies to 6%, overall rent growth is projected to increase throughout 2024 and beyond. And in terms of, there is some supply coming online, but because of the borrowing cost, there's no new supply after probably the next 1 or 2 quarters. And so what that means is overall, there will be a supply-demand mismatch, allowing for rental income to go up and NOI to go up. Finally, in terms of multifamily debt originations, what this means is how active is the transactional economy in multifamily. And it has been at an all-time low, but they're showing some signs that it's starting to tick up and have a rebound in activity. And the examples that Chris mentioned of KKR, Brookfield, and Blackstone, which are all large private equity organizations, is an example of that. And then finally, it's with the new construction dwindling down and overall long-term rent growth, this favors overall increased occupancy and increased performance of these multifamily properties. And because cap rates have expanded and properties are at a discount, at some point this will trigger this economic cycle we showed where there's a buying opportunity. This is buyer's market, probably phase 1, and we're going to have that for a year or 2 as we move into buyer's market phase 2. And so with these reasons, multifamily is a good defensive choice as well as an offensive choice to place your investments. And with that said, let's talk about when multifamily is done right, what does it look like? You have a hedge against inflation, as Chris mentioned. It appreciates over time. There's year-over-year rent growth. There's portfolio diversification depending on where you invest in the country. It's a long-term asset which has good stability, consistent housing demand. There is cash flow, and there's profit upon sale plus the tax advantages. Now, when it's done wrong, let me show you what that looks like. You mistime the sale, or you have no choice, but you have to sell due to your debt situation. Variable rate debt, we know, can cause complexity. Capital calls, obviously, is no fun. No cash flow, buying in poor locations, no clear strategy. You don't do a cost segregation, or you don't do value add, or just banking on speculation. Next. So the reason why value add is sort of like it's almost like a nitroglycerin, or a sort of you juicing up an opportunity, is essentially when there's cap rate compression, which we expect to see, or once interest rates do drop, there is a automatic price increase. There's a value increase, right? If the NOI is 1.2 million, purchase price is at 20 million, and cap rate's at 6%, cap rates compress just by 50 basis points to 5.5, you immediately go and you gain almost $2 million of value. That's with just pure cap rate compression alone. But let's look at it when you add in value add. Let's say we renovate 75% of the units, we put in like $5,000 a door, and we do all of this stuff. Well, NOI goes from 1.2 to 1.4 million. Cap rates still the same cap rate compression of 50 basis points, but now you're getting close to $25 million of appreciation. And so when we look at opportunities, we're looking for organic improvement in things, macroeconomic improvement in things, and then we're also going in there doing forced appreciation with our value add strategy. Next. So how do we find bulletproof deals during market volatility? This is due to the number of volume of deals we look at. We are canvassing the whole country. We probably look at 2,000 to 2,500 deals a year, and we put it through several layers of analysis. And we're looking for a few key things. One is location growth. Next is there ability to add value? Is there strong tenant demand that is not based on just one employer, but multiple employers? Is there a compelling fixed rate debt? Are they motivated? Do they need to sell, or is this just like if they can get the best price? And then finally, we're finding these pockets in Atlanta, for example, where we're going a little bit outside of Atlanta to find opportunities. In Austin, we're going in the Austin-San Antonio corridor. New Braunfels is a submarket that's very unique and has hyper growth going on. In Phoenix, we found a place called Peoria that we'll probably have a deal coming up soon where there's opportunities there that are very unique. And so these are very unique submarkets within a thriving macro MSA. Next. Great. And our latest project, you want to go back one slide, please? Our latest project is Villas at Sundance. This is the opportunity where it met the criteria we just talked about. It was strong tenant demand, strong employer demand. We were able to negotiate. These were motivated sellers. They have to sell. There's a time deadline for them to get out and exit the deal. And that allowed us to negotiate a discount that we'll share with you in a second. There's so many things about this deal. The price per door is unheard of for this Austin MSA kind of area. I mean, we're getting for $146,000 a door for 2012 vintage that looks like a resort spa. It's 93 to 95% occupied, and we're able to still achieve a 2x multiple with the cap rate compression as well as our value add plan. Next. And so some of the key reasons, we mentioned the prime location with Tesla producing so many gigafactories there, Google having a huge presence, Microsoft, Meta, NVIDIA, all these companies have a huge presence in Austin. San Antonio is also growing like wildfire. There's a high growth potential in the actual submarket of New Braunfels. It's considered the third fastest growing city in the country. There's a strong cost base as we talked about. It is a strategic acquisition with value add, operational upside, as well as a motivated seller. And obviously the robust demand of tenants in the area make this a smart move for us. And so here's some of the new information. If you happen to catch our previous webinar, the newest information is it is a gated community. We were able to purchase this at an impressive discount. We've done the cost segregation study, so we're going to share with you what that looks like in terms of how much tax savings you can get. It is a luxury location with a strong tenant base, and again, hyper growth based on the demographics of all the employers surrounding it. And Chris, you want to stack on this?
Yeah, I can stack on that. So I had the opportunity to go, as I do with all of our properties, and walk the property and walk all of the units and check out what the tenant profile was like. And the pictures really don't do it justice. So you can see here this lake that's at the front of the property, which isn't our responsibility, but our tenants get the benefit of having the walking trails that go around it. And it's really beautiful. And that's the property manager told us. This is the thing that none of the other properties in the area have. So you have the whole back half of the community that actually has lake views from their apartment, which it's really fantastic. I think visiting most of the Viking properties, this is clearly the top, if not one of the very top properties as far as finish and build. This is a true flight to quality, which I think is important in this market. And you still have a value add component because the property's still 12 years old. And when we get to the halfway through our business plan, it's going to be 14, 15 years old. There's going to be things that we can upgrade and increase rents. But when you walk through this property, it feels like it's brand new. What you're looking at is the bid-ask spread, and you're looking at all the different asset classes. So the same story that we were discussing on a few slides before, we were talking about the Fed and what optionality people had and what they were investing in. This is kind of illustrating that in a graph. So what CBRE is telling you is if you look at the cap rates in office and retail, multifamily is holding really strong. Now, industrial, I think, is a really solid asset class to be investing in. However, it's not an easy asset class to invest in, and you really have to have the right connections to be investing in the right types of industrial projects. And then what this is also showing is the bid-ask spread between the current cap rate, the suggested cap rate, and what the properties are actually trading at.
So as we mentioned, we were able to negotiate a $500,000 discount from the seller due to some of it was due to the volatility of rates. Some of it was due to their need and necessity to close at a certain time, and they were highly motivated. And so these are the kind of deals that if you told me a year ago, 2 years ago, 3 years ago, that if I wanted to get them, they were not possible. And so what this tells me is the economic environment has changed. And so the other great thing is one of the criteria we have in multifamily is, hey, look, if I'm going to buy a property, I want to buy it below replacement cost. What does that mean? Replacement cost means if I wanted to build this thing brand new, what would it cost me? So we have a developer on our team, Ed, he's also our asset manager. We've also talked to local developers. They're estimating this would cost $250,000 per door to build something like this. And we're getting it for not $148,000, but now $146,000 per door. The other thing is, because of the hyper growth in between Austin and San Antonio and that I-35 corridor, the municipalities are now putting in taxes and fees and restrictions on new multifamily growth and just new construction in general. So anywhere between $337,000 of fees you have to pay or taxes you have to pay up to $2.3 to almost $2.5 million. And so what this means is it's getting even more and more expensive to build.
Yeah, and stacking on top of that, that's something that you can't replicate that. So if you built for $250K per door and that's your basis, some of the new supply that's coming on in the area does present a short-term risk because they might be offering concessions. And eventually those concessions burn off and they still are at a $250K per door. So they're not able to keep up with us on rent prices. Tax benefits. So I think a lot of you have had this conversation with us. These limited partnership investments into multifamily deals have pass-through tax benefits. And it's a form of accelerated depreciation that you're able to use and offset on any other passive income you have. So the way that we're able to accelerate the depreciation is through the process of doing a cost segregation study. So built into the tax code and introduced in the IRS rules is that you are able to take a building, and this doesn't have to be a multifamily property, it's just more powerful in a larger building, and you do a cost segregation study. And what they do is they take out the land value, and then they start putting different aspects of the property into different buckets. And everything that falls into a bucket under 15 years can be accelerated into year one. Now, this is incredibly powerful because when you can take your depreciation, or at least a big portion of it in year one, in an asset you were only planning to hold for 5 years, the other option before they introduced bonus depreciation as an IRS benefit was to take straight line depreciation over 27 and a half years. So if you were going to sell in 5 years, you were never going to actually be able to reap all of the rewards. Being able to accelerate it into year one gives you a nice chunk of a loss on your K1 when you get your report back, and you can file that along with your taxes and offset passive income that you have from other assets. If you don't have passive income, you can still offset the income that you derive from this investment yourself. So for this property, we've done the cost segregation study, the preliminary one, and we have a pretty good idea that on a $100,000 investment, you're going to be able to get a $55,000 to $60,000 K1 loss in year one. So that,
and when he says loss, guys, that means that it's a paper loss and it's just a tax benefit that you can take and you can actually save. You can either use it on the income we're going to give you, but if there's leftovers, save that, and you can always reap it or harvest it later on any other type of passive income in the future.
Correct. And it's a strategy. So if you're storing it and you're coming out and you're going to have some big capital event, like you're selling an investment property 2 years from now, you can hold on to that loss and use it then. And next slide. So the reason that it's important, and we're talking about harvesting the losses, this is a strategy that a lot of our investors have taken, is to collect as much bonus depreciation because the IRS tax code is expiring. And the way that it was set up was in 2020, every year from 2022, it went from 100 to 80% to 60% and so on. So this year you're getting 60% of the depreciation. So that slide we were looking at that was showing different parts of the asset that was going to create bonus depreciation or accelerated depreciation. The way these percentages work to erase the confusion is if your property created 10 million of applicable bonus depreciation, in 2024, you're able to take 60% of that, so 6 million, and then that 6 million gets divided amongst all of the equity that's in the deal. So that is what gives you the idea of either 50 or 60%. And so next year, the very same deal, this exact same deal that's creating 50 to 60% of bonus depreciation this year, next year it's going to create 20% less until it's phased out. There is legislation that is in the works to permanently bring this back, and I think it's a very politicized tool that both sides of the aisle are arguing about this. It looked like it was going to get approved, but with the election coming up, it's likely that you should follow this step down until it's finalized. And definitely for anyone that's interested in this deal and wants to participate, book a call today. Me and my team would be happy to chat with you about the deal, go through the numbers, look at the underwriting. We have a video of me walking another investor through the underwriting. Please reach out. We'd love to, build a relationship.
Great. And then, Chris, we have some really good questions coming in. So what we'll do is, as we rocket through some of these last slides, we'll save some time and answer these questions because I really want people to feel that their questions were answered and they have a little bit of clarity.
Yeah, absolutely.
So proximity is power, guys. This particular project, it happens to be located in sort of the triangle, if you will, between Austin, San Antonio, and Houston. It's essentially a stone throw from both Austin and San Antonio, and it is really in that hyper-growth I-35 corridor. Next. So the growth of the population is what the story is here with Austin. More than 5 times the nation's population growth rate. There's some crazy statistics like, I don't know, 200 families moving in every week kind of thing. So it's amazing what's happening here. And they predict the San Antonio Austin quarter could eventually have like 5 to 7 million population between the two cities. Austin's median home price has increased by more than 100,000. Again, making it very reasonable to assume that most people can afford to buy and they will most likely rent. Next. As I mentioned to you, all the huge employers, we got Amazon, Apple, Tesla, Dell, Oracle, Google, Meta, and then we have like the UT Health Sciences System. We got the Texas government. We got the Joint Base at San Antonio. We got all these other USAA, IBM, keep going. And then this just came out, I think a week ago. Caterpillar just announced they're going to write about 17 miles from our property, a $90 million plant in New Braunfels. Next. So Chris gave his prediction earlier. I'm going to give you mine. I predict one rate cut and it'll happen in November. And the reason why is the Fed, even though they're doing their best to be apolitical, obviously are always political, but to be as apolitical as possible, they don't want to influence the elections because a cut before the election will help Biden. And so if they want to stay as clear as possible, I think they'll try to do a rate cut in November. That's what I believe. But regardless, we're positioning Viking Capital and the way we're thinking about things. If there's no rate cuts, we have a strategy. If there's a rate cut, there's a strategy. And really, we're opportunistic. We're opportunists. We fortified our current portfolio. We restructured whatever we need to restructure. And now we're looking for opportunities where it's not going to be a long period of time where people are pencils down like this. And so we're being very selective, almost like a sniper, and really selecting the most ripest, juiciest opportunities out there that meet our criteria, and we heavily vet them, and then we go after them. So next slide. And so I think this is what a target rate for Fed meeting. So probably is the November, right? So is this, the federal funds rate where it's going to be? So some people think a group is thinking it's going to stay in the federal funds rate between 5.25 and 5.5. There's a group the biggest group is saying it's going to be 5 to 5.25, and then there's another group saying 4.75 to 5. So we do have a bonus distribution for anyone who's investing, and the deadline was May 21st. But Chris, you have an update?
Absolutely. We've decided to extend it until our funding deadline. A lot of folks have reached out, and frankly, we're very worried that they weren't going to get the bonus distribution. And after chatting with Vic and Ravi, the decision has been made to extend it until June 1st and make sure that everybody gets the bonus for coming into the deal before we close.
Okay, great. So let's answer some questions here. And before I do that, here's how you can invest. A lot of people don't realize they have money sitting on the sidelines that's not participating in actually getting true returns. And so a self-directed IRA can be very helpful. Can you go back one slide? Sorry. Obviously, cash, a 401k, trust. There's multiple ways you can get in. Now you can go to the next slide. And so some of the questions people had, here's a question, Chris. Will a recession cause rent delinquencies resulting in lower NOI?
So I think it wouldn't cause rent delinquencies. I think where this manifests, if you see a recession and renters are unable to pay their rent, you might see a tick up in bad debt. Typically, what we've seen is rent growth stay stable. Apartment owners, especially institutions and folks that have an institutional mindset, are very reluctant to ever reduce rent. So rent usually will grow by 3% year over year or with inflation, so 3% or higher. And what you'll see concessions be made to help bring folks in, give them a little bit of a reprieve with a couple months off. And then if those folks still can't pay rent, they will stop paying rent and essentially be evicted. Now, most folks can afford to pay rent, and most people choose to pay rent because shelter is an important need for them. So most people aren't wanting to get into a situation where they're over leveraged and they have to be evicted from an apartment, struggle to get another apartment. And for the most part, the apartments in the area are all run based off of LRO systems. So the active rents in those areas are based off of what the competition is offering. So I don't think that you're going to see a huge reduction in NOI, but I think we do bake into our underwriting slightly higher vacancy, things like this, and higher concessions to plan for this type of.
And Chris, I want to just weigh in. So it also depends on asset class, right? So I think it was like, I had a friend that one time joked to me about like the different types of renters. So in a property like the Villas of Sundance, I mean, these people have at least 6 months of reserve. When you go to a B class property, they may have like 2 to 3 months of reserve, right? And then when you go to a C-class property, they're like more like month to month. And so the level of the tenant also determines how they get influenced by the economy. And so most of our assets, especially the recent assets in the last 2 years, have been really renters by choice, where they could buy a home if they chose to, but they choose to still rent. And so there's also a flight to quality. As you can see here, we bought a high quality asset. And so these properties, the reason why it makes sense for us to purchase them is because they're much more stable during downturns as well. So it's a defensive posture.
And I think if you look back to a really high inflation or recessionary area like 2009 and 2010, you saw values of single family homes and apartment complexes dip a little bit, but people still paid their rent. And that's, I think, one of the reasons why you see a lot of institutions, especially big institutions, pouring their money into multifamily is, for the most part, if people can, they will pay their rent and honor that agreement.
Here's another question. What about depreciation recapture on sale? This is back to your bonus depreciation question.
Yeah, absolutely. So this is something to definitely keep in mind. When you use bonus depreciation or any type of depreciation, you're basically kicking the can down the road. So the idea and the strategy is that if you have $200,000 in losses on your K1 and you're able to offset income that you'd have to pay taxes in this tax year, and you're able to offset those, more than likely, if you're an accredited investor, you're paying 30 to 35% tax in that year. Now, by offsetting it with depreciation, you are kicking the can down the road until we sell the property. When we sell the property, you do recapture the tax that you offset. However, now it's reclassified as a long-term capital gain, and it's taxed at a 20-ish% rate. And you have an opportunity to 1031 that money in or offset with other bonus depreciation. So the general strategy that most employ is, over time, if you're investing with different groups or investing as an active real estate investor, because you can do cost segs on your own active stuff and build up this depreciation while it's still available, is you continue to offset your taxes. And the longer that you can grow your money tax-free, the better position you're in. And what a lot of folks actually do is they'll roll this over and over and over to continue compiling and compounding their wealth, and then they'll leave it to their kids with a step-up basis. And a lot of that recapture will just disappear.
Okay, and this is our last question, and we'll let people move on here. And again, guys, scan the QR code or text Sundance or join us at VikingCapitalInvestments.com. You can also email us at invest@VikingCapLLC.com. The deal is, I would say, 2/3 fill, and probably will close up in the next couple of weeks, Chris. But we definitely want people to get in before it gets filled up. Chris, people are asking, hey, I'm a high income W-2 earner. Does this strategy make sense? What do you say?
Yeah, I would say, in my experience, and as I serve, we have almost 1,000 investors that invest with us. And I get kind of a lens to see what people are doing and how they're strategizing and kind of helping them fit this into their strategy. And for the most part, where you're limited is you need to be an accredited investor. So you have to make either $200,000 a year or $300,000 with your spouse, or have a net worth of $1 million higher. So if you don't meet those standards, this investment vehicle really isn't for you. Now, if you meet those standards, it's a great part of an overall strategy and investment strategy that you can employ. And the tax benefits combined with the ROI that you get as these properties increase in value and give cash flow, it is a fantastic strategy for you to employ. And as you look at things, there's going to be times when the stock market is a great time to invest. There are going to be times when you want to invest in bonds, and you're going to want a diversified portfolio. But real estate gives you a really nice all-weather strategy that if you build a small active investment and a large passive investment, those are the most successful people that I've seen over time that have income that they can generate through active real estate that passes on through passive real estate. Because at a certain point, you're going to stop wanting to put all of your sweat equity into the deals that you manage.
Awesome, guys. Well, thank you so much for joining us on this webinar. If you have any questions, please book a call. We're always here to help support you guys. And even if you just have more educational questions, we're also here to help on that. So Chris, thanks for joining me, and everyone else, thank you so much. I want you to wish you a good night, and we'll see you soon.
Thanks, Nick. Bye, everybody.